FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today is December 5th, 2019. Well, you've been listening a while. You know our feeling, our take on the economy, the real economy. Is it really going up? Are more people really working? Are you working? Or are you working a lot harder to make a fraction of what you used to make 20 years ago or 10 years ago? Maybe that's the real economy. We don't know that for sure, but certainly the evidence continues to come in. And, well, then we get to the stock market. It just keeps going up, setting new records. It's just this giant wish fulfillment machine that just creates wealth. Just, it's like the slot machine in Vegas that always pays off. That's the stock market of today. But will it always pay off? Will it keep paying off? Well, what do you think? Why don't you email us, kl@kerrylutz.com. Tell us your views. Well, right now you're going to hear from Michael Pento, Pento Portfolio Strategies, an economic expert, somebody we turn to. Michael, it's great to have you back. So the stock market, I remember back in the 80s and 90s, people said real estate just always goes up. It keeps going up and up. Is that the perception now of the stock market?
Well, thank you so much for having me back on, Kerry. And first of all, I'd like to point out that since January of 2018, the stock market is just up a handful of percentage points. So people seem to forget that in the fall of 2018, the entire economic construct came crashing down. So you had a total freezing of credit markets. Wasn't one junk bond issued in the month of December. The average stock in the Russell 3000 was down some 35%. So it was a total wipeout. We were heading over the waterfall without a barrel and with a big anchor around our necks. Mm-hmm. And that is when the Fed abruptly changed course. Remember the brazen Jerome Powell said, hey, we're going to raise rates 50 basis points above where they think inflation would be, or above their so-called R star, or, the rate that's neither a governor on the economy or stimulative to the economy. So that was 3.5%. They were promising to go to 3.5%. And they were also very brazenly burning base money supply aggressively at that time. Mm-hmm. That all changed in 2019. So we able to have a very good year so far. I mean, we don't have the month of December yet in the books, but I'll tell you this, that there has been no material increase in earnings whatsoever in 2019. It has all been an expansion of PE ratios, and it's not predicated on any strength at all, any healing at all in the underlying fundamentals of the U.S. economy on any metric whatsoever. It's all about money printing, debt accumulation, and asset bubbles. And that, my friend, is not a viable solution for a healthy economy or market in the long run.
Mm-hmm. Yeah, well, so basically nothing's happening. Earnings are flat. And we just see the market going up because, what is it, lack of other venues to invest your surplus funds? Or is it printed money? Or what is it?
There is no alternative. They call it TINA. Well, I'll tell you another reason why, or expand on the reason why the stock market hasn't crashed yet, is because who in their right minds really believe that the central banks of the United States and Europe and Japan and China would actually agree that ZIRP, or zero interest rate policies, is something we should embrace forever? Who would have ever thought a decade ago that quantitative easing would ever occur in the good old USA? And it is now something that has become permanent. Remember, the Fed promised they were going to burn their balance sheet, burn that excess reserves, burn it into an incinerator, and take the balance sheet from $4.5 trillion back down to, say, $2 trillion, which is still much higher than it was prior to the Great Recession. It was $800 billion prior to the Great Recession. They were going to burn trillions of dollars of base money and really start to enter into reality in the banking system. That never happened, Kerry. The Fed turned around on a dime, and now it's not only permanently monetized $3.3 trillion, it is now permanently adding to that at a rate of $60 billion a month, but just don't call it QE. Just call it, I guess, debt monetization like Zimbabwe would do. But that's what they're doing.
Yeah.
So the entire global world's central banks, the Fed, the ECB, the BOJ, the PBOC, I'll just look at those four central banks alone, have printed $14 trillion of new confetti, fiat money since 2007. And you wonder why the market hasn't crashed yet. But there will be, Kerry, this is important. There will be a day when the recession comes, the downturn comes in the manner of 2018, fall 2018, or 2007, or 2001, and we'll turn to central banks and they'll say, they'll just raise their hands in the air and they'll say, what do you want from us? We are already in QE and we are already at 0% money. What else can we do? And then they'll say, well, what about the fiscal side of the ledger? The monetary side of the ledger has already been used up. What about the fiscal side of the ledger? And then they'll say, well, global debt has already surged. And this came out by Reuters, and it was a study done by the BIS and the IIF. Global debt is now $255 trillion. $255 trillion. It's 330% of GDP. And there are studies been done that shows that economic growth is fettered when that ratio is 90% debt to GDP, not 330%. That is the real problem. Mm-hmm. So there's nothing to do on the fiscal side. There's nothing more we can do on the monetary side. And that is when the real crash will come.
Hey, so that's a great question. So, it used to be for every dollar of debt the government took on, there was a dollar of growth, and then it went down to 90 cents, then 85. When does it get to the point where for each dollar of debt taken on, we start seeing negative growth, that it actually does more harm than good? Are we there yet? Is that
close.
Possible?
We are very, very close, because all of this, not all of this, but most of this debt is unproductive in nature. The U.S. is now running trillion-dollar deficits like it was nothing. And that's without a recession. With the recession, our annual deficits will approach $3 trillion. Kerry, that's 15% of GDP. We are positioned now to look like a banana republic. And like you said, taking on debt to buy back shares is unproductive debt. You want to have debt that comes as a wish or fulfillment of what the private sector denotes as necessary, not with a centrally planned government forces upon the economy. And that's not just the United States. That's the case in Japan, Europe, and especially in China.
Yeah. Malinvestment is what we Austrians call it, when the money is too easy and it flows too easy, and it actually becomes a justification for projects, or as our neighbors to the north would say, projects that are not economically viable or reasonable, that don't have a reasonable rate of return, but for the cheap existence of cheap or low cost, no cost debt. Then all of a sudden, every economic project becomes viable, and then you have the boom, and then eventually you've got to have inflation here, right? I mean, inflation in the terms of, we know the inflated money supply, but inflation in terms of decreased purchasing power.
Right. So that's where I think we're headed eventually. So we do have inflation. It drives me nuts when people say we don't have any inflation. I know you didn't say that, but CNBC will tell you, well, the PE ratio of stocks should be 20 because there is no inflation. I mean, well, we are almost at, if you look at core PCE, what the Fed measures as inflation, we're just below 2%. If you look at core CPI, we're above 2%. which is the asinine, central banks, universally adopted, universally believed nirvana of inflation, with the way they measure it, is 2%. Because don't you know, economic growth collapses if inflation is 1.9%. It's got to be 2%.
Yeah, that's a must.
We have not only do we have $1 trillion deficits, Gary, but fiscal 2020 just started with October, as you know, and that monthly deficit was $134.5 billion in one freaking month.
Wow.
That is up 34% year over year from last October. What a way to start our fiscal 2020. And like I said, this is without a recession. So we're taking on all this debt. Most of it now is being monetized by central banks. You ask about inflation. Well, inflation is already above the Fed's asinine 2% target. And this has been going on for many, many months. It's not a new phenomenon. We have runaway inflation in asset prices. This is why there's a massive boom in the homeless population in California, in Seattle, and around this country. People cannot afford the rent on a home, even if they have a job, because these homes have been purchased by private equity firms and speculators in real estate because there is no alternative. Kerry, when you have $15 trillion worth of negative yielding debt around the world, that pulls down all other fixed income bonds on the planet. And what do people do? They go out and buy junk bonds. They go out and buy the riskiest forms of debt. They speculate in the stock market, and they buy up all of the houses that they can possibly get their hands on.
Yep.
And this is a part of the evisceration of the middle class.
Yeah. Witness
Thanks to the Fed.
Hey, so, you're in the New York metropolitan area. I was there. I think they're getting close to like 15, 20% inflation there, largely because of the inflation in asset prices, real estate prices, where these stores, like, being in Florida here, going into a store, filling up my basket with $100 worth of stuff in Florida, as opposed to New York, you get like, 3 things on the bottom of your bag in New York because the rents and everything else and the taxes, all these things are combining. So yeah, maybe the price of gasoline is, under $3, but when you go into a store, of course, everything you need to live is outside the core consumer price index, CPI. But I'm telling you, like, you can't sit down at like a luncheonette in New York for like under $100. I think the inflation there is way, way out ahead. And I assume that this is taking place in all the go-go real estate markets, LA, San Francisco, probably Boston to some extent, and Miami. I know for sure in Miami because I live in Florida. It's happening there. It's shocking.
FSN Radio. It's all about what's next.
Silver One Resources is an exploration and development company backed by strategic investors Eric Sprott and SSR Mining. The company is focused on its Candelaria mine project in Nevada, where there is already a historic resource estimated at 127 million ounces of silver. The Candelaria mine historically was the highest grade silver producer in Nevada, generating over 68 million ounces of silver at an amazing average production rate of over 1,250 grams per ton. The project has tremendous expansion potential as past drilling has outlined deeper, high-grade silver targets for future drill programs. Silver One is highly leveraged to the price of silver and is cashed up and poised to increase shareholder value. Silver One trades in New York under the ticker SLVRF and in Toronto under the ticker SVE. To learn more, go to silverone.com. That's silverone.com.
The Financial Survival Network. It's all about what's next.
Well, if you look at the BLS's calculation of inflation, you will find no category in it for stock prices. And even in home prices, there isn't really a category. It's called owner's equivalent rent, which is a bastardization of really, it's much easier to figure out what the home prices are doing on the median basis. But they come up with this own cockamamie, owner's equivalent rent, and they have a trim mean version of that. And they strip out everything that went up They call it core PCE deflator, and somehow that's magically, below 2%. And that means you even have some members of the Federal Reserve saying that they're in a panic to get above 2%, and then has to be well above 2% to make up for all of the years it was below 2%. The way they measure it. So where are we headed? I mean, eventually we're headed for one of these two outcomes, Gary. This is what I firmly believe, and this is how I manage money. I have a very complex model. It's a 20-point model, 10 components for inflation and deflation, 10 components for growth and recession. We are going to enter into a period of time when we will have intractable inflation or deflationary depression. One of those two binary outcomes is coming, and it could even be both at the same time. That's where we're headed. And I believe the first thing that's going to happen will be a recession, which will blow up the junk bond market. And once the junk bond market implodes, then it's all over. There's nothing that the Federal Reserve can do at that point because there will be no new issuances of junk bonds. The Fed is already easy. The Fed is already engaged in QE. And when that market blows up, the stock market will jump. It will drop, in my opinion, lock limit down. In other words, they will close the exchange because of the circuit breakers several days in a row. That's how fast this market will crash. And I just want to, I'm not a Cassandra, and I don't use hyperbole, but I will tell you that there's a metric evaluation called total market cap to GDP. It's been around for decades. It's Warren Buffett's favorite metric on how to look at the valuation of stocks. So why do I say the stock market's going to crash? Because the valuation of equities, the market cap of equities, is now 1.5 times underlying GDP, which is in of itself falsely boosted by free money. So there will be a time when that denominator is crashing and the numerator is crashing. Both will crash at the same time. Yeah. That is never, even in March of 2000, the apex of the dot-com bubble, did we ever see that figure, total market cap of equities as a relationship to GDP, be higher? Never.
Yeah, it's really interesting when you look at it because GDP is such a flawed measure. It really doesn't measure wealth creation, because I always like to point to the fact that Bernie Madoff contributed positively to GDP until he got exposed as a fraud, and then he was a drag on GDP. So it's really a flawed measure for figuring out exactly what's happening, because it takes into account debt and other factors that aren't really necessarily economically positive. And so we're looking at gold now. Now, gold is approaching its seasonal time, end of Q4, beginning of Q1, where we see gold and gold stocks go higher. Looks to me like it's going to happen a little earlier this year. It usually statistically averages December 15th. We're now December 5th. It's going up. What's your take on it? Where do you see it heading?
Well, I love to own gold when real interest rates are falling and the dollar is also falling. I mean, that's rocket fuel for not only physical gold, but especially for the miners. I usually avoid the miners when gold is in a bear market, because if gold's in a bear market, the miners are going to be devastating, as I'm sure you are aware. Oh, yeah. So if you think real interest rates are going to drop, and I am of that belief, I believe between now and the end of Q2 be a very special time to own gold. What I believe is going to happen is you'll see Jerome Powell, who's now Jerome Powell, the head of the Federal Reserve, is now of the belief that the Fed funds rate is perfect. It doesn't have to be moved higher or lower. But I believe that the well anticipated and hoped for and prayed for rebound in the earnings per share growth on the S&P 500 is not going to show up in 2020. And if that is the case, the stock market is going to plunge between now and the end of Q2. And if that is the case, that is going to set Jerome Powell back in motion to cutting rates to zero, not towards zero, to zero again. And he'll be at the same level as the ECB and the Bank of Japan at that time. But the stock market is going to anticipate that move, and gold is going to anticipate that move. So you want to be in that environment where you see nominal interest rates falling, real interest rates falling even faster, and the dollar rolling over, as it comes to be known that the U.S. growth is no better than that what we see overseas. So yes, I am a big bull on gold. I have about a 10% position in the physical gold in the portfolio right now. I plan on increasing that position as I see the data roll over. So what data am I looking at specifically? I want to see the ISM services data start to contract. I want to see initial unemployment claims start to rise. I predict it's going to happen. That's what my model says. I want that data to be confirmed empirically, and then we'll add to the position in the miners and in physical gold.
And those miners could go dramatically higher if the price of gold and silver starts to really get jacked up.
Oh, absolutely. I mean, if you start to see the price of gold, which, by the way, has been, Bloomberg did a great study on this. They showed that debt to GDP ratio and the price of gold, they tend to go in lockstep together. As we see that ratio get higher and higher, you might see the price of gold shoot up towards its all-time highs, and then you see the miners just rip higher because they have not performed. I think they're still down about 50-60% from the all-time highs seen in 2011.
We're getting to near all-time lows on the TSX Venture. It closed last month at 532. I think the lowest ever was 525, and that after gold has gone up pretty significantly over the past year. The miners,
Gary, that's why I say that physical gold it has less volatility, has a much better long-term track record. But if we enter into a aggressive bull market in the metal, that's when the miners really outperform physical. And I got to say, how could we not? If you look at U.S. business debt alone, U.S. business debt is up by 60% since the Great Recession, and it now totals $16 trillion. Gary, 12% of businesses around the planet are zombie companies. In other words, they have to issue debt just to pay interest on the outstanding bonds. I mean, how is this sustainable? It is unsustainable. It is an ersatz facsimile of what an economy should be. And when interest rates rise, either because of inflation, which would pop the bubble in sovereign debt, or because of a recession, which would pop the bubble in junk bonds, that is when reality will hit, and it will take a lot of people by a huge, shocking surprise.
Yeah, because the stock market always goes up. And when you talk about companies that can't pay the interest, effectively, they're paying interest on interest. My grandfather, who came to this country at like 1 year, 2 years old, who had an 8th grade education, but became a very successful businessman during the Great Depression, always said, if you're paying interest on interest, you have a problem.
Oh, yeah. Very wise man. I would say you have a very big one at that, a huge problem.
Yeah.
People don't understand. I mean, even if you look at the U.S. 10-year note, the U.S. 10-year note is now yielding about 1.7%.
Correct.
Well, prior to the Great Recession, that interest rate was above 7%.
Mm-hmm.
So you have bond yields in Europe, in Greece, where Greece used to have a 2-year note that was 200%, and now it's less than the U.S. 10-year. I mean, do people have to have? I have all the data and I have all the facts in my head and at my fingertips. So you have to realize we being global central banks have engineered and fomented the biggest bubble that could ever be imagined in history. It is a global, international, worldwide bond bubble that will and must absolutely implode at some time in the future. And there's a tremendous opportunity. You don't have to be afraid of it. You can actually protect and profit from it. And that's what I intend to do.
And that is a great point to end it, because if you see a train coming at you and you're stuck on the intersection there, your car died out on the tracks, you better get the hell out, because if you don't, that train's going to hit you. And if you see it coming, forget about the car, forget about saving your vehicle, save yourself. So there's an economic train coming right at most of you out there. You don't even know it. But if you do what Michael says and you just open your eyes, it becomes very obvious. And then once you know it's coming, you can get the heck out of the way. And you know what? Maybe you'll buy a Tesla.
Well, like you said, Kerry, there's lots of things you can do other than just blindly holding a closetly indexed S&P 500 portfolio and paying a manager a lot of money to do it, and then lose half of your net worth for the third time since the year 2000. There are things you can do. In an inflationary default, you can own gold, you can own tips, precious metals. In a deflationary bust, you can own certain types of bonds, you can own cash, you could short the stock market. So there are things you can do to proactively protect yourself. You don't have to be a passively managed pigeon.
Yeah, and just be a sheeple being led to the slaughter. That's what it comes down to here. Hey, 10 years, we had a pretty good run here, Michael, where you could just do anything, earn a return, and things looked on the surface to be pretty good, but percolating underneath were all the problems that you just mentioned, debt in particular, and nothing's been done about it. The old Talleyrand expression, we've forgotten nothing and learned absolutely nothing in this time, and that's where we're at now for sure. Hey, where's the best place to find your work these days, and how do we sign up for the free newsletter?
So I have the website is Pento Port, P-O-R-T, pentoport.com. I have a 5-week trial subscription to the midweek reality check, which I give you all the data and my analysis every Wednesday. The cost for that podcast is only $49.99 a year, $49.99 a year. If you have around $100,000 to invest, I will take you in as a client and manage the money personally for you. My email address is mpento@pentoport.com. And the office number here is 732-772-9500.
Okay. And unlike other entities that manage your money, you're actually concerned about what can go wrong, not about everything that's going right and will have to keep going right for the value of your portfolio to stay anywhere near where it is. I mean, that's the big danger is, like you had in your newsletter, it's priced for perfection, right?
Exactly. That was the latest commentary, price for perfection. That's exactly what the stock market has become. At the highest valuation in the history of the stock market, everything has to go perfectly. And given this artificial construct that we have, trust me, it will not go well.
We believe you for sure. Hey, questions, comments for Michael? Tell us what you think, where you think the market's heading in the economy and the debt. The email address is kl@kerrylutz.com, Twitter feed @KerryLutz, Facebook page, Financial Survival Network. Please visit our website. That's financialsurvivalnetwork.com. And regardless what you're listening to this on, platform, whatever, please like it, share it, subscribe it, comment, answer all your comments, and really helps us so much when you do that. Michael, no doubt we'll be talking again very shortly down the road. If I don't talk to you before the holidays and the new year, happy and healthy to you and yours. And we'll talk to you in 2020.
God bless you and have a great holiday season.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.